All right, class, welcome. Today, we're going to dig into something that's way more interesting than just numbers on a spreadsheet. We're going to explore the invisible architecture that actually keeps a company from collapsing from the inside. We're talking about internal controls, and I'm going to show you why this is probably one of the most practical and crucial topics for any of you who want to be leaders in business. So let me start by asking you a question. Why do seemingly good companies, the ones that look completely untouchable, suddenly fail? We see these huge, dramatic headlines when it happens, but what's really going on behind the scenes? Is it always some huge, disastrous decision or one single corrupt executive? Well, sometimes, but honestly, the truth is often a lot less dramatic and way more dangerous. It's usually about the little things, the things that go unnoticed, day in and day out. You see, massive failures often start as just tiny cracks in the company's foundation. Think about it, a small accounting error that nobody ever corrects, a minor expense policy that everyone just kind of ignores, maybe a few dollars of theft from a cash register that no one notices. In isolation, these things seem, well, trivial, but they add up, they compound over time, and they don't just eat away at the company's money, they eat away at its culture until the whole structure is just fragile and ready to fall apart. This is the exact problem that a strong system of internal controls is built to prevent. So, our first step today is to accept a fundamental reality of doing business. The risk of fraud is constant. It's always there. Now, this isn't about being cynical or distrustful. It's about being a prepared, effective manager. You simply have to understand the threats that can and very often do come from inside your own organization. Okay, let's break these common types of fraud down because they really do attack a company in different ways. First, you've got embezzlement. This is the classic hand in the cookie jar scenario. It's an employee directly stealing company assets. That could be cash from the register, inventory from the warehouse, you name it. Then there's financial misstatement. This one's a bit more deceptive. This is what we call cooking the books, deliberately making the company look more profitable or healthier than it really is. Why? Usually to trick investors or to get a loan the company doesn't actually qualify for. And finally, kickbacks. This is a type of corruption where a vendor secretly pays an employee to get a contract. It completely poisons the well of fair business. Every single one of these erodes trust and can have absolutely devastating consequences. So, how do we fight back against these threats? Well, our source material gives us the blueprint. The answer isn't just to go out and hire good people, although, of course, that's important. No, the real answer is to build a system that makes it really difficult for even a good person to make an honest mistake and nearly impossible for a bad person to get away with fraud. It's a system built on checks and balances, constant monitoring, and total transparency. Okay, so if fraud is the enemy that's always at the gates, how do we defend our company? Well, we build a fortress. And in the business world, that fortress is a well-designed system of internal controls. Now, this is not just some dusty binder of rules sitting on a shelf. This is the living, breathing architecture you designed to protect a company's most vital assets and its reputation. So here's the formal definition, and I really want you to focus on the three distinct goals here. Goal number 1, prevent fraud. We just talked about that. Goal number 2, protect assets. And that means everything, cash, inventory, but also intellectual property and company data. And goal number 3, and this one is absolutely critical for you as a future decision maker. Ensure the accuracy and reliability of financial reporting. Because if you can't trust your own numbers, you are flying blind as a manager. You cannot possibly make good strategic decisions. Now listen, if you only take one single concept away from our entire discussion today, please make it this one: segregation of duties. It's such a simple idea, but it is profoundly powerful. It just means that no single person should have control over every single step of a transaction, from the beginning all the way to the end. It really is the ultimate application of don't put all your eggs in one basket. Let's make this real. Look at how this works in a very simple, everyday cash sale. Notice we have 3 distinct roles, and they're handled by 3 different people. First, the salesperson has authorization. They talk to the customer, they make the sale, and they create the official record, the invoice. Second, the cashier has custody of the asset. They're the ones who handle the physical cash and get it ready for the bank. They don't create the sale, they just handle the money. And third, the accountant has the record-keeping responsibility. They take the invoice from the sales team and the deposit slip from the cashier and make sure those 2 documents match perfectly. You see? Each role acts as a check on the other 2. Now, really think this through for a second. What happens if we give all 3 of these jobs to one person? Let's call him Bob. If Bob does all 3 jobs, what could he do? Well, Bob could authorize a sale to his friend for a massive discount and no one would know. Or he could take a customer's cash, put it right in his pocket, and then just delete the invoice, so there's no record of the sale ever happening. Poof, the money's gone. By segregating these duties, any kind of fraud would require at least two people to team up and collude, which is way, way harder to pull off and a whole lot easier to detect. Okay, so you've designed this incredible fortress. You've segregated duties. The walls are high, the gates are strong. Everything seems perfect. But how do you know the system is actually working the way you designed it to? How do you know one of the guards hasn't fallen asleep at their post or that a crack hasn't formed in the foundation? Well, you have to verify, and that is exactly the role of the auditor. Now, it's really critical that you understand there are two main types of auditors. First, you have internal auditors. These are your own employees. Think of them as the guards who are constantly walking the castle walls, testing the locks, checking for weaknesses. They report directly to management and the board so that fixes can be made in real time. Then you have external auditors. These are from an independent outside firm, and they're usually hired once a year to give an objective outsider's opinion. They don't report to the CEO, they report to shareholders and investors. Their job is to certify to the public that the financial statements the company is releasing are trustworthy. So the most important point I can make here is that a good audit is not a punishment. It's not some gotcha exercise. A good audit is an incredibly powerful tool for improvement. A great audit will give you a roadmap for making the entire company stronger, more efficient, and more secure. And that, in turn, builds trust with everyone who has a stake in the business. All right, that's enough theory for now. Let's put this into practice. Let's put you in the hot seat. You're the manager, you have this knowledge now, and you have to use it to make a critical decision. So this financial snapshot lands on your desk. At first glance, it looks fantastic. A cause for celebration, right? Sales revenue is up 25%, net income is up 30%. But then your eyes drift down to that last line. Cash flow from operations is negative $250,000. Whoa, that is a massive red flag. We're reporting a huge profit, but our actual core business operations burned through cash. How is that even possible? Are we booking all these sales but not collecting the money from our customers? Did we buy a mountain of inventory that's just sitting there, not selling? This kind of discrepancy between profit and cash is a puzzle that a good manager absolutely has to solve. So what do? What's your first move? Do you storm into the sales department and start accusing people of making bad deals? Absolutely not. A good manager's first thought shouldn't be about people. It should be about the process. Based on the things we just brainstormed, collections, inventory, what is the first internal control system you need to go look at to figure out why profit and cash are telling two completely different stories? And this right here, this is the key to being an effective manager. Your job is not to play the blame game. Your job is to methodically investigate by trusting the systems you have in place. A well-designed control system gives you objective data. It lets you follow the transactions, pinpoint where the breakdown is happening, and find the root cause, whether it's an honest mistake, a bad policy, or, yeah, maybe something worse. It provides you with data, not drama. That scenario we just walked through leads us perfectly into our final section for today: how to avoid the analytical traps that so many students, and to be honest, a lot of new managers, fall into when they first start looking at financial data. The single most common mistake I see is getting tunnel vision on the income statement. You see that big net income number, that big profit, and you think, great, we're successful, we're healthy. But a professional manager knows that the financial statements are like a three-legged stool. You have the income statement, the balance sheet, and the statement of cash flows. You have to analyze them together. Profit without cash is a classic warning sign. It could mean you're actually on the path to bankruptcy, even while reporting record profits. The professional approach is to find the story in the relationship between the statements. So, as you all move forward into your careers, I want you to anchor yourselves to these three core principles. First, risk is not an exception to the rule. It's a constant. So build systems to manage it. Second, a strong system is always more reliable than a single trusted person. Trust is wonderful, but a great system is better. And third, remember that controls and audits are not just a burden or a compliance checkbox. They are a competitive advantage that helps you build a resilient, trustworthy organization. So I'll leave you with this final thought to chew on. Somewhere in your future company, right at this very moment, a problem is starting to take root. It could be a simple process flaw, an honest error, or a deliberate act of fraud. The question you have to be able to answer as a leader is this: is the system that you're responsible for strong enough to find that problem before it finds you?